again with Personal Finance Boss, and we're here with another episode. I tried not to make my voice change. We are here with another episode of Personal Finance Boss, and today we're going to be talking about insurance.
Yes, this is going to be one of those alley topics where he will be doing most of the talking.
Oh, you know a lot about insurance.
I just know that they always win.
You know how to monetize insurance.
What do you mean?
I would say like coming up with creative solutions on how to buy insurance would be your forte.
Really? You'd have to explain that to me because I'm not sure.
Well, like the thing you said, if you have like healthy parents, you take out more insurance.
Oh, okay.
Like something like that. It sounds worse than it is, but we'll explain it as we go into the podcast.
Yeah.
So what does insurance do, Julian?
Well, Ali, insurance, like we all know.
Mm-hmm.
No, it's just a way to protect yourself.
Mm-hmm.
So protect yourself for unforeseeable events, protect yourself for events that if they happen, the slight chance that they do happen, they will cost you a lot of money. And most people won't be able to afford that.
Mm-hmm.
So if you're driving your car down the highway and you crash into a bridge and the bridge crumbles and you survive, odds are you won't be able to afford the construction or the fixing of the bridge. So you pay for insurance, right?
Yes.
I mean, that's property and casualty insurance. How do they call it?
Oh, okay. I thought you were going to use that example for life insurance, and I was like,
no,
later.
No, but this is the most common insurance that people deal with the most.
Yeah.
P&C insurance.
Yeah, property
and casualty insurance. Yeah. So explain that from the beginning.
Property and casualty insurance, very cool. You're basically taking out policies to protect material property, usually. So your house, your car. In Julian's case, if you're a bridge owner, so you'd be taking out property on that, and that's usually to protect yourself from any damages, any liability, any unforeseen events. Most insurance plans don't cover natural events, so earthquakes, flooding, all of that.
Well, home insurances do. This one, the one here and the one next door for the condos do.
For earthquake, it covers it.
Yeah.
And for flooding and stuff?
Yeah.
Okay.
But for flooding, it's stupid because I'm on this unit is on the 12th floor. So I mean, if this floods, then we're all pretty screwed.
But but I think it also depends on the area you're in. If you're in a flood zone,
it'll be more expensive.
It'll be more expensive, or they might say we don't cover for that event.
No, but I mean, an insurer will always usually cover for it, but they'll charge you for it.
Yes.
Because, like I said at the beginning, the insurance companies always win.
Yeah.
So an example of an insurance is, okay, if you buy a condo or a house, you're going to get home insurance. If you live in the house or if you rent it out, it's two different types of insurance. But let's say you live in it, you can insure, or you're going to insure against earthquake, for example, against flooding. You're going to insure
against theft.
You're going to insure what you have inside the house. So your couches, your TVs, your computers, your beds,
jewelry.
whatever, your jewelry, all that is insured.
Against fire?
Yeah, fire as well. And that, for example, would cost you, say, $45 a month. And in the event of something happening, then you have what they call a deductible. So you need to pay the first $500 if the deductible is $500, and then the insurance company covers the rest.
Yes.
Correct?
Yes.
So if they say, do you want to decrease your deductible, you may think, oh, it's going to cost me less money,
but it's
going from $500 to $250. But it's more expensive for you because actually, if ever something were to happen, you'd only have to pay the first $250 instead of the first $500 or the first $1,000, depending on what you're insuring. The deductibles are different, so the higher deductible will give you the cheaper premium.
Yes, it means you have to pay out of pocket for more.
Yeah, in the event that something happens. But since insurance companies always win, which would make sense, because if the insurance companies actually paid out more money than they made, they wouldn't be in business. So just going on their odds, if you just play the game like they play the game, you get the highest deductible possible because the odds of something happening to you are slim.
Yeah, but then you don't want to end up getting like a $2,500 deductible. That's a lot.
Yeah, no, definitely it's a lot. If you know you can't afford it and it only costs you an extra $12 in the year, then obviously...
Yeah, I would say like a deductible between... Well, I would say depending on what it is... I think for your home, between $500 and $1,000 is manageable.
Yeah,
that's a manageable one. You can do $2,500, but that's a lot.
Yeah, but I mean, if
a lot of damages can be done in $2,500.
Yeah, if you're willing to claim an insurance, how do you say
claim?
File a claim.
Yeah.
If you're willing to file a claim, it's because there are significant damages that happen to your home, and it would cost you a lot of money. If your roof caved in and it's going to cost you $50 to replace, even though, that's unrealistic. You wouldn't call the insurance, A, because it's not above your deductible, and B, because you don't want to have a claim on your record. Because when you have a claim on your record,
premiums will go up.
Premiums will go up, and when you change insurance companies, they always ask you. I don't know if they check. I don't know if they can check. They can check?
Pretty sure.
I mean, knowing how stupid banks are, how they can't check cross banks, I don't know that insurance companies can check cross insurance companies. But hypothetically, or what they want to make you think, is that they can see whether or not you made a claim in the past 5 years, 7 years,
5 years, 5 years.
5 years. And if they did, and if you did, they're like, oh, well, this guy's more likely to claim money than some other guy, so we're going to charge him more money for the claim that he did 2 years ago with another company.
They also look at different factors, and they're going to look at it for any insurance. They're going to look at usually they're going to look at demographical information. So your past claims and everything. For housing, they're going to look at the location of the house.
Yeah.
They're going to look at, is it a condo? Okay, is there a security guard in the unit? Like all these different little factors that sometimes we wouldn't necessarily think about. That can really have an impact on your on your premium that you pay.
Like for car insurance, if you live in a bad neighborhood and you park your car outside, they ask you, okay, is your car parked outside, and where do you live?
Yeah.
And then depending on the neighborhood, I'm sure they will adjust your premium if there's more theft.
Well, for cars, because I just did it. So location, do you park inside or outside?
Yeah.
Is there an alarm system on your car?
Yeah.
Is there, like in Canada, we have Sherlock, which is like basically each part in your car is labeled. That says it belongs to this VIN. So if someone were to go and resell it outside, it would be like implanted on the engine or whatever that the VIN number is this thing. So it's very hard to sell. So all of those would decrease your premium.
Also, the distance that you drive. Is
distance that you drive.
That's the biggest one.
Do you drive for work or do you drive just for personal uses?
Yeah.
How much do you drive each day? For driving, they can check if you've had previous accidents.
Yeah.
That they can check because that's a government record, so that they can pull up, and previous claims and anything like that. Speeding tickets, they'll check. So all those kind of
things.
Any
tickets that affect your points, if I'm not mistaken, will...
No, anything that goes on your license.
Not that take points away only? That affects...
So if you have a speeding ticket, but it didn't take away points, they'll still... You can check that,
Because I've gotten tickets, but my
because chances are, if you're speeding, it makes you a reckless driver, even if you.
No, what I'm saying, if you do like
parking ticket.
No, not parking ticket, but like I don't
stop
know.
sign.
But that's reckless, like driving in a bus lane.
It goes, but if they took your license out, it's on your license then.
Yeah, no, it's definitely on your license, but I don't know that it changes your premiums, but. I think anything that does points affects your premiums.
Yeah, for sure, because it's more of a... chances are if you're speeding, chances are you're getting into an accident. Also, for driving, if you're a guy, your premiums are higher.
Which should not be the case, but it's just because guys... That was a delayed laugh. But it's guys, we have more of a macho attitude and we're willing to take more risk.
For a younger guy, also, the premiums
25 and less,
your premiums are pretty... You're getting dinged a lot.
Yeah. Even if you're a responsible driver, it's not your fault, but just on average, statistically speaking, younger drivers are worse.
Statistics, unfortunately, do not help with insurance because it always feels like
they don't help the outliers.
You get the bad brunt of the stick.
Yeah, always. So that's car insurance, and then there's also civil responsibility. Is that what it's called in English?
For
the condo insurance, I had to get a minimum of $2 million.
Yeah.
But
that's the liability, the civil liability.
Civil liability. Yeah.
But that's in case like a tenant suing you or something.
Okay.
That like they fell in the unit or they tripped or something.
Yeah.
In the States, suing is a lot more of a
more of a
thing.
game.
It sounds like everyone in the States has sued or gotten sued by someone at one point.
Yeah.
And their typical response is, why don't we just go sue people? So in the States, the liability is a lot higher, and your car insurance is a lot higher in the States. In Quebec, it's a lot lower because here we have the government body that actually pays. It's limited to $250,000 for
SAAQ.
The SAAQ.
Yeah.
You can't, in an accident, you can't claim higher than $250,000. Like that's for damages, for like car damages. For medical damages, it's different because that depends on the situation, but it's capped at $250,000. In Ontario, in the States, it's not, so your premiums are going to be a lot higher because chances are what the insurance would have to pay out is going to be a lot more in those jurisdictions. But mainly what I wanted to talk about in insurance was life insurance, because that's where you're gonna get that really covers your life, that covers your family, that covers your estate, and it covers the financial side as well.
Yeah, and you have life insurance, right?
I do.
Yeah.
So usually, if you work for a big company or even a small one, you probably have it through your company as well.
Through my company.
Through group insurance. Usually, group insurance would cover one time your salary. That's what's included in your benefit.
Annual salary.
One time your annual base salary.
Okay.
So for commission, unfortunately.
Yeah.
Again, so it covers one time your base salary, but a lot of people elect to get plans outside of their work because a lot of times, imagine you have like a young family, you just bought a house, 2 kids.
You just bought 2 kids?
You bought a house,
okay.
You have 2 young kids, and even though your spouse is working, you still need 2 incomes to support everything. So sometimes in that case, 1 income is not enough to supplement that, and a lot of times. So now we get into the topic of term insurance and permanent insurance.
There you go. Now you can start talking, Ali.
You don't want to talk?
I actually, honestly, I know very little about life insurance because I don't have a life insurance policy myself. Mm-hmm. I know that if you want to win, you get it on your terms.
Do you think it's something? do you think it's something important that people in their 20s and 30s should be thinking about?
I mean, the whole argument around life insurance, like the main rationale is when you die, you don't want to leave your kids or wife or husband or whatever in debt. So or you don't want your death to cause financial troubles for them. Not because they have to pay for the funeral, but if you didn't finish paying off your house, if you had a line of credit, if you had any other form of debt, that debt would be then transferred onto your beneficiaries, right? Mm-hmm. If they accept to take
So the debt is the debt is given regardless. Like
really?
So for debt they'll go after the next of kin.
I thought if you declined everything, then you don't.
You can't. No? It doesn't unfortunately work that way. Like people ask me sometimes, it's like, so what stops me? Like if I know I'm gonna die, can I go on my credit card and spend like $25,000 and then I kick the can and I've just like gotten away with $25,000?
Yeah.
And unfortunately, it doesn't work that way because they'll go after your next of kin.
Okay.
And they'll say, now you are liable.
What if you have no one?
Then it becomes a situation. But then the thing is, if you have no one, chances are at that point the bank is not going to let you take that so much on like that. And chances are, if you have the higher credit limit, chances are you have the assets that they can go after.
Yeah, unless you
have like literally like zero. Yeah. Like let's say you have 0 assets in the bank. Doctor tells you in 1 month you're going to die of cancer. And you say, okay, fine. So you go to the bank. You take a cash advance of $5,000 from your credit card.
No, but you don't need to take a cash advance. You just spend everything on the card.
So you spend everything on the card.
Yeah.
And then you don't have to pay it off. You die. But here's the hitch. What if you don't die? Then you have no limit left.
You're going to make sure that you
have $25,000 to pay off. You have no income and you have no assets.
Yeah.
And you have a medical disease that needs treatment still.
Yeah.
So it's not really a smart idea. And no one ever thinks of that, and I always laugh when people ask me that. I remember asking my dad that question 5-10 years ago. I'm like, what if we do this? He said, that's such a smart idea. He's like, yeah, but if you live, you're screwed.
So if you're sure to die, then go for it, and if you have no one else. But the idea is that if you have a family, if you have, I guess whoever else is on the will, right?
Yeah, so whoever you want to leave, whoever you want to take care of when you die.
Yeah.
That's basically it. That's what insurance is.
Let's say I have a kid.
Okay.
But on my will, I just put you. Everything goes to you.
Me?
Yeah.
Oh, thank you.
But then I have a whole bunch of debt. Do you take the debt, or does my kid take the debt?
It would be the next of kin. Because I don't know you, so I'm not liable for you.
Okay.
Your family is, like your spouse would be liable for that because they can see like, oh, the property is owned by 2 people, then they can go after that. They really can't go after me because there's no civil recourse. The only thing they could go after me is any of the joint investments. Yeah. Any of the joint properties. Yeah. But that's how it works. But if we go back, there's 2 main products in insurance.
Well, actually, yeah. So the thing was more explaining why life insurance. Mm-hmm. And explaining whether or not I thought it was a good idea. So that's the idea. You want to not have your next of kin or kids or whatever or spouse in trouble when you die.
Yes.
Next thing would be, well, hey, if I die, why don't I make them rich? Why
Yes.
don't I
Yeah.
transfer money? And apparently, my mom trains a lot of Jewish people, and it's very important in their culture. I mean, culture, whatever. They usually tend to have very high life insurance policies. So, we may say, oh, the Jewish people are rich because blah, 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 blah. But one of the reasons behind their wealth is obviously they understand business there. They're well versed in that area. Just culturally speaking, it stems back to when they weren't allowed to own land, right? Way, way back when. Anyway, off topic and not important. But because I know a few, and they're very, very keen on life insurance, meaning that's one of the ways that they transfer wealth on to their siblings. Because if you have a $5 million life insurance policy and you die, well, hey, there's $5 million.
Yeah, and that's where the saying, well, it doesn't come from Jewish people, but generally the saying that goes, you're worth more dead than alive, comes from the fact that you have a $5 million insurance policy. Why don't we just kill you?
Yeah.
And we'll get $5 million for you.
There's clauses though that prevent that.
So
you have to make it seem like an accident.
That's advice you can go to Julian for privately on the side.
There you go.
To figure that out.
There's movies that have done that, right?
Oh, yeah. Kill someone for the insurance.
There must be.
Sponsored by Sun Life.
Do you know what type of clauses are in the contract? Like, you can't die in the first 2 years of taking on the policy?
Yes, so you can't die within the first 2 years of taking on the policy. Suicides have recently... So suicide is a kind of like a 50-50 type... No, so it's kind of a 50-50 type battle.
Okay.
In terms of if you could claim insurance if someone died by suicide. So it's a long investigation and everything. If someone dies at home and stuff, so if someone dies without the hospital, in any place besides a hospital, then obviously there's an investigation and everything that goes on. And a lot of times there are a lot of cases where insurance will deny the claim because
of course
this person was drinking while they were driving, for example.
Okay.
Then your policy would be void because you didn't die. Yeah, because you didn't die of a natural. You didn't die of a natural. Like, you died of something that could have been
that you caused.
Yeah, it could have been prevented.
Yeah.
So just things like that, and in some of those situations, you really see those are some of the situations where the kids are like really bad off now because they needed that $300,000 or $400,000 that comes through.
Do they get the money that the guy contributed, or they get nothing? Wow, so it's a win.
So
it's a win for the
it's
insurance
not a
company.
win for. Okay, we can't really call it a win
for the insurance company.
Yes, but it's not a win that like, oh yeah, woo, we won.
I'm sure there's some executives like, oh, we'll meet our target this quarter because this guy was drinking and drive. Like,
okay, I don't know what happens there, but there are times when it loses. But the biggest thing I see is where insurance people make money is with policies called term insurance. So term insurance is one of the policies you could get for life insurance. It basically covers you for a certain policy amount for a set number of years.
Okay.
Usually in Canada, we have a T20, which is 20 years, and a T30, term 20 years. So within that 20 years, you can get a policy, for example, if you're a healthy individual, of a $2 million policy, it'll cost you $350 a year. Okay. So like for you right now, if you went to Sun Life, you got a T20 for $2 million, probably under $1,000 a year you pay.
And when can you die?
So in any time within that 20 years, except the first 2 years, if you pass away,
it's 20 years as of the day that you go see Sun Life.
As the day that you sign the policy.
Oh, it's not.
That's the first day.
It's not like I'm 20 now and I want a life insurance between the age of 50 and 70.
No. That's more expensive because you're older.
Yeah.
So the younger you are with insurance, the cheaper your policy is. Much, because chances are you're not going to die.
But then it begs the question, do you need a life insurance policy at 20? If you die at 25, how much debt can you possibly have?
But it's not really, I wouldn't look at it that way. I would look at it that the insurance policy that you could get today versus the one I can get 30 years from now is much cheaper.
Yeah,
far
but
cheaper.
If your T20 lasts 20 years, in 30 years from now, like...
So I'm very against the term policies.
Yes.
I don't understand them. Yeah. I don't get them. But there's a thing out there that people say, look, chances are you're going to have kids, you're going to have the high expenses, usually between the ages of 30 to 60.
Yeah.
Because at 60, your kids are grown up, they have their own jobs, they don't need your money. They don't need your money anymore. Get out of my life. Some people say, why should I be paying a huge premium to kick something back to them when they have their
Yeah.
money, they have jobs and everything.
Yeah.
That's why people get term policies. I'm more of the thing that I might as well get a term policy. I might as well get a permanent policy while I'm 20. The policy amount will be less, but now I'm covered for life.
Yeah.
So I don't have to pay any more insurance ever again. And I think that's a much better thing. The term insurance, I can pay $300 a year, and if I don't die within that 20 years, I've lost all my money.
You can't get it paid out to you?
How? You didn't die.
No, because there's ways, I forgot how they specifically call it, but you can like take the money out early.
So that's if you have a cash surrender value
Okay.
in a permanent policy only.
Okay.
So the permanent policy do have cash surrender value.
Explain what that is.
A cash surrender value. So over time, the premium you've paid in a permanent policy only accrues in the account.
So by premium, he means, let's say you pay $50 a month, that's your premium.
Yes.
And then you accumulate that over many years. The insurance company invests it.
Yes, they do.
So they do offer you a return on that money.
Yes. And that money can be taken out
Yeah.
of the policy.
Before you die.
Before you die, it can be taken out as a policy in two ways. One is a loan to you. So
Okay.
you take out, I don't know, $40,000 as a loan to you,
Yeah.
payable back to Sun Life. You don't lose the insurance policy. Or the other one is, I want to stop the policy completely. I don't want to pay more premiums. Give me my $40,000 cash.
Yeah.
I take my $40,000 cash. The policy is void. I
Yeah.
get my money back.
Yeah. Okay.
So that's how that works. I think the permanent policy is much better. It covers you for life. If you get it younger, it's much cheaper.
Yeah.
And obviously, the older you are,
And why is it cheaper?
because the chances are you're not going to die
Yeah, and
soon.
since you're not going to die soon,
'Cause
start
you're
paying
younger.
earlier.
and you're healthier.
Compound interest.
Yes.
They get to make, it's like if you start investing at 20 or at 60, investing for 10 years and letting it grow for 40, and investing for 10 years and not letting it grow at
Mhm.
all, the amount of money that you're going to end up accumulating is going to be very different.
Mm-hmm.
That's why when you're younger, it's cheaper because your money gets to compound for much longer time.
Yes, and also for the insurers, there's a lot less risk insuring a younger
Yeah.
person versus an older person.
Yeah.
And insurance is one of those things. As soon as you have something wrong with your health, your premium goes up right
Yeah.
away.
So if you're a smoker,
Yep.
if you've lived through cancer, if you've had cancer, you beat it, I guess.
Yep.
You got
Survived
over
it.
survived it, whatever. Your premiums would be much more as well. What else? If you have, what about
Diabetes, high
Genetics.
blood pressure, you're on what kind of drugs you're on, what kind of health problems you have, literally every. They'll take your weight, they'll take
do they
your
send
height.
you to the doctor?
Yeah, so you have to get a blood test
physical.
done. You have to get a physical done. They're gonna check everything
Yeah.
before they offer you that insurance plan. So while you're younger, it is, no one really thinks of it while we're young because we're like, we're not gonna die.
Yeah.
We don't think of it, and I don't blame them.
Or we think of it, but like it's like saving for your retirement. Like
Mhm.
it's in 40 years. Why would I even care?
But it's a very smart financial tool to have, and it also can help you out when you go get mortgages and stuff. I wouldn't suggest doing this, but if you have a permanent policy, that cash surrender value, it's yours. You could theoretically use that as a collateral on loans and line of credits and mortgages later on down the line.
Yeah.
I wouldn't suggest doing it
Yeah.
because you need that policy and you've paid for it. And if, God forbid, you have a health crisis or something, you won't get that policy again at that same price.
Yeah.
So you could use that as collateral. There's a lot of people out there that actually think that, hey, why don't I have 50,000 here? Let me take it out as cash, kill my insurance policy, and I pick up 50,000 cash. I really strongly advise not to do that.
Yeah.
It makes no sense to void such a cheap insurance policy that's probably already paid up after 20 years
Yeah.
and just take 50,000 cash.
Okay. Question. I get to ask questions now.
Yeah.
On a term insurance policy,
Okay.
do you pay premiums all your life, or do you stop paying? At
So
some
you
point?
pay, if it's a term 20, you
Sorry,
pay for 20 years.
not what I meant. A permanent.
Permanent.
policy.
So depending on the policy you have, some of them, like Sun Life has a policy right now that you pay the same premium for 20 years.
Yeah.
After 20 years, the premiums stop,
Yeah.
and your policy amount is, let's say, $300,000.
Okay.
So you pay the same amount for 20 years, then it stops,
Okay.
and you get it.
Okay.
The other thing that I look at is in companies, for example, you could get additional insurance at your work, for
Yeah.
example. You could get, because you're in your 20 to 30 bracket.
Remind me to talk about sickness insurance.
Yeah,
Keep
that's
going.
a very important one too. But
going.
at McGill, where I work right now, the group rate is very cheap. Extremely cheap per $1,000 chunk of insurance. So I could get like $1 million worth of coverage, and it'll cost me maybe $2,000 a year.
And that's permanent or term?
Term.
Okay.
So it's only, and it's term, and it's not term. It's only as long as I stay at McGill.
Okay.
But I'm paying $2,000 this year.
And when you leave McGill, you lose.
I lose the whole thing. So for me, when I looked at that, I said it makes financial sense to get the cheaper one. But chances are, in today's work lifestyle, where we're not staying at one company, we're constantly moving companies, and I just started my career. Chances are I'm going to move. Why should I pay out insurance policies to so many different places? I should just get one plan. My policy amount will be cheaper on a permanent, but at least I'm covered for life.
Yeah.
And I don't have to worry about another policy again.
Yeah. So the next thing that I wanted to mention is sickness insurance. So if you're working, you get sick, meaning cancer or Alzheimer's or some serious thing. I'm not sure exactly what would be covered, what wouldn't be covered, but that's going to be.
It's called critical illness.
Clearly explained in the contract.
Uh-huh.
But then you get a payout as well.
Yes.
And you can combine sickness and life, meaning that if you get sick, you get money. If you die, you get money as well.
So the way critical illness works, it's very expensive.
Yeah.
It's a lot more expensive than term or life insurance. The policy amount's going to be a lot less.
Because you can get sick more than once, but you only die once.
Yes, but the policy will only cover you one time.
Yeah.
So if I get cancer, I take my $200,000 and my policy is done then.
Yeah, and the reason why it's more expensive is if you look at breast cancer, like how much one woman out of 3 gets breast cancer or something, it's crazy.
But it's also covering a wide spectrum of diseases. It's covering all types of cancer. It's covering any illness that's going to keep you off work for a considerable amount of time. The only good thing with critical illness is if you never end up using your critical illness, the premiums are paid back to you.
Okay.
So those ones, the premiums are paid back.
Is critical illness term or permanent?
It's until you get
a
sickness.
So then how do you know that you don't get a sickness until you die? It's when you die they pay that back?
Yeah. They pay that back out to your estate or your beneficiaries.
Okay, here's something of interest.
But they pay your premiums, not the policy amount. They just return your premiums.
Yeah. Okay.
So they've still picked up all the interest money.
Yeah.
So they win.
They win.
They win.
If you were young, whatever, life insurance. Why would I need life? It's so uninteresting to be paying for something that I'll get when I'm dead.
Yes.
How do you, like we've talked about a few ways, but how would you get life insurance money before you die?
How would I get it?
How would one go about getting life insurance?
If I was a beneficiary on someone else's plan and they pass away, I would get money.
Indirect, but I guess that counts.
Yes. But you're saying, like, how do I get my policy money while I'm still alive? Well, like, how do I personally benefit from my policy?
How do you personally benefit from your policy?
Okay.
I guess if you have a thing where, okay, my parents have it because their parents had it and their parents had it, and we've been benefiting one generation above, so it's your responsibility to get it for your kids. And when your parents pass away, you'll get their money. So in a sense,
there's that trend that goes on. There's also the financial burden that's lifted now that after 20 years, if anything happens to me and my income, my kids will be covered. So that's your burden that's kind of lifted. Yeah, and it gives you, and you could say, hey, I saved $3 million throughout my life and I'm retired now. I don't need to give them this $3 million and spend it. And when I die, they'll get. You just hope you die in the right way. The skydiving. The way I think what Julian is saying, there's a lot of different ways you can go about it. If you have healthy parents that are, let's say, in their 40s, 50s, or healthy parents, you could take out. So you could say, Mom and Dad, I'm going to take out a $250,000 policy on your life, permanent or term, whatever you want. I will pay the premiums, but you make me the 100% beneficiary.
One of a family friend told me that once. I'm like, really? I guess you can do that. It sounds kind of gruesome, but
it sounds bad. It sounds bad as it is, but from a financial perspective, it makes a lot of sense.
It makes more sense to you taking a policy on your parents than it does on yourself, because you won't get to benefit from that. Not saying that you should benefit from somebody's death, but if we take all emotional aspects out of death and you just look at it, like Alex said, from a financial standpoint, that's one of the ways that you can benefit from getting a life insurance policy. Just it won't be a policy on you, it'll be a policy on your parents, for example.
If you die before that, then it's a double lose. The insurance wins twice.
And another way to get...
I wouldn't know how that works. That's actually interesting. So I'm the owner of the policy on my parents. I'm the 100% beneficiary. If I die, is there like a legal way that you could change that structure then?
Well, they would change the beneficiary right on the policy. It wouldn't go to the dead guy.
But you're the owner.
No. I don't know that you would be the owner. I think your parents set it up as if they were paying.
Okay.
And they can pay them and you pay them back.
Okay.
I don't think it would work that way. Yeah. Another way you can get your money early, like we talked about earlier, was the cash surrender value. So you just say, I don't want to do this anymore. Give me my money plus whatever interest it accrued based on whatever investments they've done, whatever money they want to give you.
The yields now are a lot lower. Back in the 90s, the yields were a lot higher. Yeah. So there's different ways you can go about it too. If interest rates ever pick back up, insurance policies have this thing where you could do an upfront payment. So you say, okay, here's $20,000. They put it in a trust for your policy, and the interest on that pays the premium every year.
Okay.
You get it?
That seems like a win for the insurance and a lose for you. You lock up money.
Yeah, but the thing is,
I guess if
your policy is covered then.
Yeah.
So you don't have to worry. Yeah. You don't have to worry about it.
It's like a high interest saving account with no risk.
In a way, yeah.
Because if you invested that money in a regular saving account and you took the interest to pay your policy, it's the same thing. Mm-hmm. Just they probably offer higher interest at the life insurance policy.
They offer a higher rate, but also that money is now earmarked for that policy.
Yeah.
If usually we have...
Can you take that out after the $200,000 that you gave them to pay for the premium?
I don't know about that. I've never done that.
You should have done your research.
Oh my god! Where's your little tablet with the scroll of notes? You know, that I don't know about, but I can look into it. And we have our following.
Speaking of looking into it, you don't get the Personal Finance Boss emails, but someone corrected our credit card episode.
Oh yeah.
Yep. Let me get his name. But they were saying that. Let me just get his name. Keep talking about insurance.
Oh, interesting.
Go. Keep talking about insurance.
I'm interested in this.
Okay, but in the meantime, just keep talking about insurance.
I don't know. You kind of interrupted my train of thought now. Yes, but I will come back to that in the next episode. But it's.
I have it.
Okay.
Finished. Joel contacted us about our credit card episode, which was number 38. Mm-hmm. And he said that the interest that you pay once the grace period is over, so let's say you made a purchase on October 1st and on October 31st, and your statement dates were those, beginning and end 1st and 31st, and then after the 21-day grace period, the first day of interest that is calculated, or that the way that they calculate it is based on the purchase date. They don't start calculating your interest at the end of your statement date or at the end of the grace period. They start calculating the interest based on your purchase date. So the accrued interest on your October 1st transaction compared to the accrued interest on your October 31st transaction will be different. The October 1st would be a month more of interest.
So they calculate, if I miss my payment, they calculate interest based on the purchase date?
Yes.
Wow.
Yes. Just to win more. To win harder. They do that. Just as an FYI, thank you, Joel, for getting to us. Prou Deschamps, I think is his last name, which means he must be a Quebec listener.
Well, yeah, he quoted Tangerine, so he's Canadian.
Yeah, most of them, I guess, are Canadian. But there you go.
Oh, interesting.
So thank you, Joel, for correcting us. We love that.
Yeah, I knew that interest grace period does not apply to cash advances. That I didn't know. Oh, interesting. So, viewers, if you need to use interest on your credit card, which you shouldn't be, schedule your larger items towards the end of your statement.
But that makes sense.
No, but
just purchase stuff later on to pay less interest.
It goes back to like something that's important, which I think we can talk about in another episode. Is really managing your cash flow and timing expenses. Yeah. I remember when I was a kid, I'd go to my dad and I'd say, "Dad, can you buy me this toy?" So he'd be like, "Yeah, sure. How much is it?" I'm like, "I don't know." Toys R Us, we were there yesterday. It was $100. So I said, "Okay, fine." But he said, "I can't buy it now. I'll buy it in 3 weeks for you." Yeah. So me as a kid, I was like, "Why? Is it because you don't have the money?" He's like, No. We'll buy it in 3 weeks. I have time then. So I was like, okay. And it only dawned on me like a couple of years ago.
Probably doesn't forget about it.
No, he's like, because if he bought it 3 weeks later, it would come in the statement that comes in 2 months from now.
Really? That's why?
Yeah, it's smart.
Well, I thought it was more like, okay, my kid's gonna change his mind in 3 weeks.
Also that by the time 3 weeks came, I completely forgot about the toy, and he didn't have to buy it.
I think that's more what it was.
But if he ended up doing it, just like timing different things, if you're aware of your statements, if you buy something on the day, the following day after the statement closes, you won't have to pay that for another 51 days.
Yeah. Exactly.
So, from a financial standpoint, it gives you couple paychecks to catch up to kind of buy some of those expenses.
Yeah.
Which is interesting. But if you're timing your cash flow that way, banks win more than insurance companies. By the way, if you notice with banks, this is like a little really big tangent. If you're paying account fees on your bank, they will debit the transaction fees on the 30th of the month and credit your interest on the 1st of the month. And because interest is calculated on the ending balance of every day, imagine you're taking out $3 across 1 million accounts and getting 1% of that back each month. Yeah. Every time, just for checking accounts and then business accounts. So all these different accounts they're paying interest on.
I mean, we already did a bank bashing episode. We should do another one.
It's time for another one, you know?
Yeah.
Get some extra punches out there. Sorry if there's any bankers out there, but...
Well, no, these aren't bankers. These are people that work in... Well, no, yeah. But mostly branch banking, because that's where we, the consumer, lose. But, I mean, there's winning at all levels of banks, which is why they can report like a $2 billion profit every quarter. Yeah. I mean, there's a reason why they can do that. Anywho, back to insurance, Ali.
I think we...
Okay, no, PNC, life, health...
Property. There's pet insurance.
Yeah, there's pet insurance.
Pet insurance. I figured out about that recently. I didn't
don't know much about that.
You have pets.
You can get insurance on practically anything.
Well, yeah. I know people like surgeons have insurance on their hands. Yeah. People that smell stuff for a living have insurance on their noses. You can insure a whole lot of things. Obviously, the more you can get malpractice insurance. But obviously, the more niche you're getting in insurance, you can insure mortgage bonds too.
Yeah. I wonder who did that. Angie.
But you can get insurance on practically anything. But just remember, the more niche you're getting and the more risk there is to the insurance company, the more expensive your premium it's going to be. Honestly, you can go to an insurance company and say, I have this rare manuscript from the 1830s that some king gave my father. It's been passed on for generations. I'd like to insure it against any loss. They'll say, yeah, sure. And they'll have an assessor come in and do the assessment, and you'll probably be paying, I don't know, like $2,000-3,000 a month on that to insure. The insurance is there to win, like Julian said, so they'll insure anything they want. As long as they're getting their policy.
You know what the insurance there was? There's insurance on mortgages. So you go to the bank to get a mortgage, you can pay extra for insurance on it.
Okay.
And if you co-buy a property like we do, and I would get sick or something, or I die, they only cover my half.
Yeah.
They don't even cover your half.
But there's a lot of there's a mortgage out there, so you could get a mortgage. You get an insurance policy on the mortgage when you're buying it. The bad thing about that, which is what our mortgage rep told me when I got when I went to go see them for questions, let's say I get a mortgage of $160,000. Yeah. I'll get, when I start that mortgage, I get a policy then of $160,000. My mortgage payment will go up, but as my principal gets paid down, my policy amount goes down too. Yeah. So I'm paying more money to just cover my mortgage for no reason. You understand?
No.
Okay, so I get a $160,000 mortgage. Yes. I tell them I want insurance on that mortgage. Yes. So they tack on like $30 a month, and I get an initial policy amount equal to my loan value. Yes. But as my loan value decreases, my policy amount decreases by the same rate.
Obviously. Yes.
And my premium paid decreases slightly every month until they all reach zero. Yeah. But I'm at the end of the mortgage term. If nothing happened to me, my mortgage is paid down. Yeah. My insurance is zero, my policy amount, and I paid so much money to get it. Yeah. At that point, if you don't want to do that, what I would do is you get your mortgage, go to Sun Life next door, tell them I need a T30 because my mortgage is 30 years. I need a T30 worth $250,000 or 2 times the loan amount to cover it. Yeah. So if anything happens to you, your loan is covered, beneficiaries can pay it off, and the beneficiaries get another couple hundred G's.
Yeah, that'd probably be the better way.
Which is the way I would structure it.
Yeah.
But it's like little things like this that it's really like, it's so far-fetched to think about because you're not really thinking about that at a young age. And the banker or
whoever's sitting in front of you,
they're not going to help you with that. So it's just really being aware of kind of those products and thinking the premiums usually, unless it's a permanent policy, the premiums, if nothing happens to you, they'll be gone.
Yeah.
So it's about paying up front your premiums and getting the most return back if something were to happen to you.
Yeah.
And that's the biggest thing with insurance. It's always if something is going to happen, and unfortunately death will happen at some point. So
yeah,
might as well cover yourself, but get your most bang out of your buck for covering yourself.
Okay.
Yeah.
We did it. Insurance.
I did it.
Let's all give Allie a round of applause.
Thank you.
There you go. Good job.
You
did great. You did great. You were very energized. Yeah.
So nervous.
Yeah.
But thank you guys for tuning in. If you do have any questions about insurance or what to get, please feel free to send us an email at personalfinanceboss@gmail.com. We did start our Insta page at Personal Finance Boss, and we got a few partnerships going already.
What? Really?
Yeah, with that college and Bookie.
Oh, right.
Yeah, so we have a partnership with them, but you can reach out to us there or on our Facebook page or leave a comment for us on YouTube.
Yeah, so thanks for tuning in, guys, and we'll see you in the next one.